Welcome back. Today we will be going into your 12th module of the course Security Analysis and Portfolio Management. This would be dealing with portfolio evaluation and revision. So again, this is divided into 5 lectures. The first lecture is about Sharpe Performance Index, and within this particular module lecture, I would be covering upon the basics of what portfolio evaluation is, what are the different measurement techniques we have in portfolio evaluation, and then we will directly go into the different measurement techniques, in which Sharpe Performance Index would be the first module within that particular section. So, first let us understand what portfolio evaluation is all about. So, as the name suggests, portfolio is nothing but, in the previous lectures also I have told, it is combination of a number of securities. Let us assume x1, x2, x3 to be the securities. These could be the individual company shares, equity shares, it could be preference shares, it could be debt instrument in the form of debentures or any other such instruments which is available in the market, or derivative instrument, whatever it is. All these put together is considered to be a portfolio. And how do you evaluate a portfolio? Evaluation is assessing how well this one is performing towards achieving a particular target or goal. The ultimate idea is, it is the process of assessing how the portfolio is performing to meet the financial goals of the investor. So, if suppose I have assumed that I want to get a return of say 10% or 12%, in order to get this return of 10 to 12%, what are the different securities I have included in my portfolio, and based on the performance of these securities within my portfolio, I am able to get the objective of achieving 10% or 12% return, is the idea of portfolio evaluation. So, when we talk about evaluation, it is not just simply looking at the return of the individual security which you have in the portfolio, it is going beyond it. What does it examine? It examines the risk and how our investment is aligning with a particular benchmark or particular industry standard, right. So, it is important for us to understand that when we talk about portfolio evaluation, it does not just mean how my securities put into a basket is just performing. I am also considering the risk the individual can take, and then I am assessing whether based on the risk how I have identified the individual securities, and based on these factors whether it is giving me the return which is in alignment with the benchmark return, or I can call it as industry standard. If suppose I select particular stocks which is dependent on a particular industry, I can have industry standards or benchmarks, or it could be the benchmark which I call it as the market index or whatever it is. So, I can have different indexes according to my requirement. Now, the next question is, why do we require portfolio evaluation? What is the purpose of portfolio evaluation? So, first requirement for portfolio evaluation is to have a performance assessment. What do you mean by performance assessment? I am trying to identify whether the individual securities put into my portfolio is generating adequate return for the risk which I am taking. So, it is a continuation of what I have told, whether the individual stocks within my portfolio, whether it is giving the returns as expected for the amount of risk I have taken. So, whenever we talk about the need for portfolio evaluation, there are two major questions which should be answered. One is The first one is my portfolio meeting the expectation, whether the returns are in comparison to my expected return. And the second is I am just comparing my portfolio with similar portfolio, and I am seeing whether the return of my particular portfolio is at par with similar portfolios existing in the market or with the benchmark. Let us assume it could be the industry standard. So, that is the first important need for having portfolio evaluation. The second, as I told you, you are trying to include risk into the whole picture, where you are trying to find out whether the portfolio, whatever you have constructed, is based on the risk parameters which an individual can take, and based on these risk parameters which the individual can take, whether this portfolio is highly volatile or whether it is in a normal market is something which I have to see. So, what is the extent to which the individual portfolio is exposed to, right. So, exposure talks about the risk, and whenever we talk about the exposure to risk, it is important for us to always measure the risk adjusted returns. Otherwise, what happens is, if it is absolute number, we may sometimes avoid the risk adjusted return. So, it is always important for us to consider risk and measure the return of the portfolio based on risk adjusted return, so that the return whatever you are going to get is, it can be considered as a compensation for the amount of risk you are going to take. The third important purpose of portfolio evaluation is to invest based on goal alignment. So, you have a particular thing in your mind that this is the amount of return I am expecting. So, that goal has to be kept in mind before I take into consideration the different stocks which I am going to put into the portfolio. So, I pick up the individual securities based on my goal requirement. So, what does it say? What am I doing in order to identify the individual stock? I am doing a periodic evaluation of the different securities which is prevailing in the market, and picking up those individual securities which is meeting my current goals. Okay. So, if such things such securities are identified, then what will happen is I will be able to prioritize the financial goal. I am trying to take into consideration the market condition, and I am a little bit talking about risk tolerance over here. So, there are three major conditions which talks about goal alignment. The return whatever you would be getting is based upon the stocks which you have selected, and these stocks is in alignment with the goals which you have set, and that is dependent on the financial priorities. The second is market conditions, whether the economy is in a boom or whether it is in a recessionary stage, and the third is talking about risk tolerance. This risk tolerance is about how much risk an individual can take, right. So, I say that from 10% to 12% is my margin. So, the risk tolerance is of 2%, right. So, individually it may vary from person to person, but when you go into mutual funds, we are trying to identify similar persons who have a margin of say 2% or 5%, club it together, put it over there, and then identify and make a portfolio which matches these particular conditions of risk tolerance along with the market conditions and financial priorities of the investors. What is the importance of portfolio revision? So, first we have talked about portfolio evaluation. Second part is talking about portfolio revision. What is portfolio revision done what is meant by portfolio revision and what is the need for doing portfolio evaluation revision is the next important part. So, as the name suggests, portfolio revision means I am bringing about a change in X1, X2, X3, whichever I have identified earlier as part of my group or basket of stocks which I am having. So, over a period of time, I am trying to see why did I select these stocks, because this is matching my financial requirement, and in accordance to the goals which I have set, I have identified these stocks after a particular period. So, the achievement of 10% is per year, let us assume. I am going to look after 3 months, that is 1 quarter, and I am just trying to find out whether this portfolio is behaving in accordance to my requirement or not. And when I am doing that, I find that one of the security which I have included in my basket is not giving me the return as per my expectation. So, in that case, what is the option which is left to me? If I leave it as such, at the end of the year, this may come down to 8%. I do not want this to happen. So, what will I do? I try to replace this with some other security, let us say Y3, so that my expected return is available to me over a period of time. So, this process of looking into the portfolio which you have already constructed and making about the changes which is required within the portfolio by changing the different securities which is available is called portfolio revision. And why it is important? As I told you, it should be in alignment with your investment objective, and if suppose the market is not behaving in accordance to what is your expectation, then what will happen? We are trying to bring about changes so that the investors get the return as per their expectation. That is the meaning of portfolio revision, and that is one of the importance of portfolio revision. And as I told you, it is rebalancing of assets or reallocating of assets. Rebalancing of assets means I am evaluating this in the first quarter, and I find that one of the portfolio in one of the security in which I have put in 10% of my money is giving a better return than another security in which I have put 12% of my money. So, I am just trying to reallocate. I am going to give a higher percentage for the individual security which is giving a higher return, that is X1. I am going to change this from 10% to 13% and reduce this from 12% to 9%. So, that is what you mean by reallocation. I can have a new asset being included into the whole picture, or I can reallocate the amount of money which I am introducing into the individual stock. And why do I do this? This is to adjust the risk exposure. So, risk exposure, as the name suggests, how much risk my particular portfolio is exposed to, and in comparison with the risk the individual would be able to take. Okay. And why do we do portfolio revision? It includes, it is because of market changes. Sometimes certain things are beyond our control, where we have tried to include systematic risk and other things when we were discussing about risk. So, market changes is not in the hands of individuals. In order to bring about any changes which is happening in the economy or in the life cycle of any business in which we have invested, we are trying to change the asset value so that the risk return trade off happens over there within the portfolio. The second is the life stage and financial needs. So, it talks about the different requirements of individuals. Again, risk is basically the parameter on which it is measured. So, I am trying to categorize investors based on their different life stages, and then based on their life stages I set goals, and based on the goals which I have set, I try to identify the stocks which can meet the amount of risk this particular individual can take. So, in one of the lectures I told you there could be, if suppose I am going to just categorize individuals into two categories, young and old, then these could be persons who are able to take high risk because they have higher time of before mortality, and these would take low risk. So, depending upon these criteria, I try to find out what would be the amount of risk tolerance and what will be the financial goal of my target audience if suppose I am the fund manager. Next important aspect why this is required is performance adjustment. So, this is whatever we have told earlier, where if suppose there is an underperforming, I am just trying to evaluate the return of my portfolio, and if my expected return was 10% and if it has come down to 8%, then I am trying to either go in for rebalancing or reallocating into different sectors, so that I get the desired level of risk adjusted returns. So, this is the meaning of portfolio revision. Now, how do I actually evaluate a particular portfolio? There are different ways which can be done or matrices which is available. One of them is Sharpe ratio, the second is Trainer's ratio, the third is Jensen alpha. So, these are considered to be the major three portfolio performance evaluation techniques. Okay. And we will discuss on this in detail as we proceed. So, what is the difference between Sharpe ratio, Trainer's ratio and Jensen alpha is one important basic one idea I can give you, is that Sharpe ratio is trying to measure the risk adjusted return in comparison to the total risk. Okay. So, it is taking into consideration total risk into the picture, where systematic risk and unsystematic risk is involved over here. So, in a way, if I am going to answer, I am just trying to say that what is the premium I am going to get by means of taking a risk of investment in comparison to both systematic and unsystematic risk which is prevailing in the market. So, that is what Sharpe ratio has done. Okay. Trainer's ratio, whereas it is considering only the systematic risk into the picture. So, that is the difference between Sharpe ratio and Trainer's ratio, where Sharpe ratio considers both systematic and unsystematic risk, and Trainer's ratio is considering only the systematic risk. Now, coming to Jensen alpha is an extension of CAPM model which we have already discussed, where it is trying to evaluate the performance to a benchmark index. Okay. And how do I do that? By calculating the excess return over the expected return based on portfolios beta. So, this when I go over there, I can explain you how it is equal to it, where CAPM is referred to as, let us assume that it is risk free rate of return plus the premium. This is the expected rate of return. So, now in this alpha, what is alpha? Alpha is the, let us assume it is the market performance minus the expected return, right. So, you have introduced a new performance marker over there. We will take into consideration as we go ahead when we take one by one. together. Then there is another category of ratio which is talking about information ratio. This actually measures the excess return over the benchmark by considering the error aspect. So, considering the error aspect over here, it talks about the unsystematic risk which is prevailing in the market, and basically why what information ratio is going to give us is it talks about the consistency of my portfolio over and above the benchmark which I have set, might be Sensex or Nifty or whatever it is. So, I am trying to keep a benchmark, and then I am trying to see whether how my portfolio is behaving irrespective of the type of metrics which I would be using for calculating, and each metric would offer unique insight, and it would help the fund manager to tailor evaluate the specific portfolio and redesign according to investment goals, the meaning of it. Now, let us go into Sharpe ratio in portfolio evaluation. What is the importance of Sharpe performance ratio? So, it is Sharpe ratio, the actual name is Sharpe performance ratio, and what does it do? It helps to identify the key performance measure while evaluating the portfolio efficiency. So, what I am trying to do, if suppose the return is 10%, I am trying to find out how this 10% is being contributed by the various stocks which I have introduced in my portfolio, right. So, whichever I have used over here, and it is a straightforward way to assess whether the returns generated is in accordance with the risk setup by the individual or not. Okay. So, I am trying to find out whether the total of the risk, systematic and unsystematic risk put together, whether the individual portfolio is able to generate the return which I have set up for the amount of risk which I have taken. Okay. Now, what is its application as far as Sharpe performance index is considered? So, henceforth we will call Sharpe performance indicators as Sharpe ratio. Okay. So, Sharpe ratio is important for its broad applicability. What do you mean by broad applicability? It takes into consideration total risk, as I told you in the earlier slide, that is systematic and unsystematic, and since it is taking total risk into consideration, it is applicable across various asset classes and for various types of portfolio which you have constructed or you would be constructing. And it is very easy to interpret. The higher the ratio, the better is the risk adjusted performance, and a lower ratio would say that it is not at par with the benchmark set. Okay. It also talks about the risk return balance. So, how do I talk about risk return balance? I am already considering a risk free rate of return, and after that the Sharpe ratio is telling me if the portfolio is providing me enough return to justify the risk exposure. Okay. So, risk free rate of return is the government bond return, let us assume. Okay. So, this is already there even if I am not going to take any risk. But if suppose I am going to invest in securities which I have made into a portfolio, then the return which this particular portfolio is giving, whether it is giving me something higher than the risk free rate of return, as well as whether it is reflecting the market conditions. Okay, whether it is representing the market conditions. So, if it is justifying, then I can say that the return whatever I am going to get is justifiable in terms of risk exposure. How do I define Sharpe ratio? It was developed by William Sharpe, a Nobel laureate, and this is used to evaluate how well a portfolio return is compensating for the risk it undertakes. So, as we have talked about it in different languages, it says about the portfolio return and how much risk I am going to get for the amount of risk I am going to take within the portfolio stocks. Okay. In other words, it also talks about the excess return the portfolio can generate per unit of risk. So, that is another way of identifying whether the portfolio is matching with the goals set or not. Okay. There are different components which we will be using in Sharpe ratio. I'll go into it in a bit detail. After that, you can understand it. The different terms which we have used over here is the expected portfolio return. So, as in the earlier cases, we have the expected return. So, the average return which the portfolio is expected to generate over a period of time is what we are trying to calculate. Okay. And this reflects the historical or the projected return. So, I can use the historical prices, I can use the projected return, whichever I want to do. So, I can do an estimation forecasting technique, or I can use historical technique to find out how it has performed. Another important variable which we are going to use in the formula is sigma. The sigma is nothing but the standard deviation, which is normally used to normalize the excess return for the risk which we have taken. How we are going to use it, we will understand it over here. So, this talks about the Sharpe ratio, talks about the excess of the return which I have earned, that is ER. I have already told this is the expected return of the portfolio over and above the risk free rate of return in comparison with the sigma. So, in the previous slide I told you what sigma is. Sigma is talking about the standard deviation. Why I am using it? In order to normalize the factors which is affecting the prices in the stock. So, this is how Sharpe ratio is calculated. So, numerator talks about the expected return minus the risk free rate of return, and denominator talks about the standard deviation, and overall it talks about normalizing the excess return based on the risk taken into consideration. And the interpretation, as I told you in the earlier slide, it is very simple. A higher value of the ratio means the portfolio is giving a higher return for each unit of risk which I am taking. Why each unit of risk? Because the denominator is talking about the standard deviation, which is nothing but the risk which we have used for calculating. So, a higher ratio is always better, whereas a lower ratio is considered to be an inefficient performance of the portfolio according to experts. And benchmarking against peers, I can use this ratio to compare my portfolio performance with similar portfolios, right. So, I can find out how my stocks are performing in comparison to similar portfolios which other fund managers might have created, or mutual fund asset management companies might have created. So, that is the thing. So, a small example I just took over here, where I am expecting a return, expected return is 10%, 2% is the risk free rate of return, and the standard deviation, that is the risk factor, is 15. What is the Sharpe ratio? It is very simple. Expected return minus the 10% minus 2%, that is the risk free rate of return, divided by 15% which is the standard deviation. So, at the end I am going to get a value of 0.53. So, 0.53, what does it suggest? It suggests that the portfolio generates 0.53 units of return for each unit of risk I am taking. So, it means to say that for 1 unit of risk I am taking, I am getting a return of half of it. The portfolio is able to generate it. And why is it important? It is important because in order to bring about a risk return balance, this is important because I want to calculate and find out the different stocks which is there in my portfolio, whether it is matching the risk and the return, expected return based on which it was constructed. Okay. Then the flexibility across portfolio, I can use it in different types of portfolios. I can compare different portfolios as I told you. So, I can benchmark it with peers and other things. So, that is another important factor why Sharpe ratio could be used, and it is practical for decision making purposes because I can evaluate the investors as well as the fund managers based upon the requirement and based upon the performance of the fund. So, this talks about the risk, this talks about the performance. What is the advantages of the Sharpe ratio? It gives me the standardized risk adjusted measure. Why standardized risk adjusted measure? Because I have normalized it by using the standard deviation or the risk factor associated with it. The second important aspect when I am doing a comparison across portfolio is cross asset applicability. So, if what does it mean? I mean to say that I can use it for different types of stocks which can be part of my portfolio, whether it is shares, whether it is bonds, mutual funds. I can compare different portfolios which is available over there, and it is useful for investors to find out what are the different investment options which is available and how the performance of fund managers is affecting it and what strategy I should adopt in order to have a multi-asset portfolio. So, accordingly I can do it. The second important advantage of Sharpe ratio is ease of calculation. As I told you earlier, it is very simple: expected return, risk-free rate of return, and standard deviation. These are the three different components which we are going to which we have used in the calculation of Sharpe ratio. So, it is very simple, and interpretation is also quite simple, where ratio of 1 we call it as good, ratio above 1.5 it is considered as very good, above 2 it is considered as excellent. So, the meaning is very simple. It means to say that for every unit of risk which I am going to take, if suppose the value is higher, so since denominator is the risk, if suppose the value is equal to 1, it is good. I am getting at least the return whatever the risk is being proposed upon. If suppose it goes beyond 1, then it means to say that I am performing better, my asset is performing better in comparison to the risk prevailing in the market. That is the meaning of it, and this risk prevailing in the market includes both systematic, unsystematic risk for the individual stocks or securities which we have put into the portfolio. A third advantage is it talks about the risk reward balance. I am not taking much of a time for all these things because we have already discussed this. It talks about optimum risk return trade off, what should be the minimum risk, how optimum risk can be calculated. If time permits, at the end of the 5 lectures, I can discuss about the optimum risk return trade off and how optimum portfolio has to be constructed. Okay. Then it also talks about the risk adjusted performance assessment, because I am saying that if suppose the Sharpe ratio is less, I can identify whether the portfolio is underperforming, and if it is high, it is overperforming the risk which is prevailing in the market. Benchmarking tool, I can use it as a benchmarking tool because I can use it for various types of indexes which is available. Okay, I can compare it with the different types of portfolios existing in the market, and I can use this as a guide for portfolio revision. If suppose the value is less than 1, I can say that I can go in for a portfolio revision. So, in this particular slide lecture, I have tried to discuss about what portfolio evaluation is, why portfolio revision is done, what are the different metrics which is available for portfolio evaluation, and within that metrics we have discussed about Sharpe performance index. Thank you.